Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good news, everybody. Phil Tarrant is not here. This is Alex Whitlock stepping in. So welcome to the show. Great to have you all listening. Got a guest here, Steve Waters from Right Property Group. But before we get into chatting to Steve, just worth considering some of the things that have happened just over the last few weeks. Royal Commission's been handed down. Major findings. Guess what? Bank misconduct. Yeah, no surprises there. The big thing is, though, that the banks are really sort of deflecting the blame onto brokers. Worth looking at what's going to happen here because there are fairly major ramifications for brokers. There's been this big push for the brokers to charge you guys a fee. Seems very simple in principle. Conflict of remuneration. You know, if the bank is paying the broker a commission, surely that's not in your best interest. We all know if you use a broker, it doesn't actually work that way. The danger is that if you end up paying a fee for a broker to find you a loan, first of all, it's money you don't need to spend. Secondly, it's going to impact competition. So I think there's going to be some ramifications there in terms of mortgage lending in general. We can maybe cover that in another podcast further down the track. But looking at the marketplace right now, Steve, great to have you back.
Thanks, mate. Great to be here again.
So you've got your finger on the pulse. What's the general mood out there? It's been a challenging market for funding for investors for a while, just through APRA regulations and sort of paring back on investment lending. But what's the sort of the mood out there at the moment?
Well, it depends on who you ask. I think those that have already got a portfolio and have some experience behind them, as you say, the biggest challenge is the ability to get money. They're still quite buoyant on the asset class being property, but perhaps those who are just looking to start and are finding all these challenges. So we have the Royal Commission findings, and that's having an effect between people's ears and consumer confidence. But we also have the potential change of government that's coming up as well, and the ramifications that follow that. What we are finding, or what, more importantly, what some of the selling agents are finding is that sellers are hanging off a little bit. And certainly from a buyer's point of view, buyers are just starting to retract from the market to see what the outcome is and how it's going to affect them. But I believe as we get closer to an election result, or depending on who wins, I should say, and what they implement, you might see some artificial spikes within the market on certain types of properties.
Yeah, I heard anecdotally that auctions were quite strong in Sydney over the weekend. Yeah, which flies in the face of sort of what we're hearing about the Sydney market. I think to your point that you can get some sort of slight anomalies to to sort of market conditions.
Smaller pool too, so it doesn't take too many different results to affect the data that's coming through. But look, Sydney as a market in totality, there are some opportunities in there, and I don't suggest that everybody goes out and purchases in Sydney. But whether you're an investor or a home occupier, certain areas I believe reflect fair value. They can't retract in price too much longer. Some of the areas are getting to land value only.
But this is the problem, Steve, with talking about Sydney. I mean, Sydney is not a market. Sydney is a collection of multiple markets.
100%.
And I think that this is the really challenging thing for investors looking at, at opportunities, whether you're an existing investor and you're looking to capitalise on a bit of growth you've had over your portfolio, whether you're looking to step into the market. You get these really kind of broad numbers and, Sydney is up, Sydney is down, Sydney is flat, but
up until this weekend, if you had a look at the auction results, it might show the Northern Beaches sitting at, 60%. I'm just plucking numbers here. Northern Beaches at 60%, Eastern Suburbs at 55%, Western Suburbs at 32%. It's not one market, to your point, but then again, nor is Australia. So when we start to see the media and certain avenues of the media talk about Australia as a whole and dictate, or not dictate, but report on perhaps growth across Australia, I think that's a pretty long bow to draw.
But I think for investors, that do their homework, this is an opportunity, because I think when you understand that the media doesn't really know about the property market, and the media doesn't really care about the property market. The media cares about news and having headlines and news, And I think you can get a bit of a sense that the media is anti-property or pro-property. The fact of the matter is they're both, If people want to read about good stories about property, hey, it's all over the front cover of the newspapers. If they want to talk about negativity, it's all over the front cover of the newspapers.
Yeah, 100%. And it wasn't. I was actually having this conversation with someone not too long ago that it wasn't that long ago that every media outlet was reporting on how to become a gazillionaire overnight in property and all the good news stories around it. And it was the flick of the switch, and it was quite the opposite, and how you're going to lose so much money and prices are contracting by 50% and what have you. But I think for investors, this type of market gives you the best opportunity to diversify. So if you're loaded in one area, or not loaded, but if you've got exposure in one area, and Sydney might represent a time to get in, or whether it be Brisbane or Perth or Canberra, wherever it may be, always assessing what your your vehicle or your portfolio is at any one time is where the gold is.
I'm just going to nip back to something you mentioned, and I'll perhaps cut you off. So you said, just looking at Sydney, you said that you'd spotted a couple of opportunities in Sydney quite recently, and given the current sort of commentary, you'd feel that Sydney wouldn't be somewhere to invest right now. But just what opportunities do you come across recently, and what was it attracted you to them?
We have a couple of trigger points in when to re-enter a market, in particular in Sydney or Melbourne, because they're the two biggest markets, and usually that's around cosmetically challenged property. So I'm just setting aside pure value.
I like the way you frame that.
Cosmetically challenged. You like that? Because what usually happens is, and especially when you overlay a lending environment that we have, is that the cosmetically challenged properties are very hard for the sellers to shift because someone needs a bigger deposit, and that's hard in today's environment. Or if it's a first homeowner, they're really stretching themselves as it is to get the property without having to then renovate it as well. So they just want to move in. So the cosmetically challenged properties offer a opportunity, and that's one of our trigger points within the market. And we've been fortunate enough to get a few lately.
Hey, we bought a few ugly ducklings over the years, and the thing is, and one of the things I've learned over 25 years of investing, and I started where a lot of people do. I bought my first apartment off the plan. I was living overseas. I was in Hong Kong. It was my first Australian property. In fact, I've only ever bought Australian property, and of course, I bought an apartment in the South Bank. It looked beautiful. The sales pitch was really about, the sort of the concierge, the swimming pool, the tennis courts, and you can envisage yourself living in that place, and you know what, to be honest, at the time I bought it as an investment, I couldn't have afforded to go and live there for myself and pay the mortgage. But as an investor, I could, with the rental covering my mortgage repayments. But it was really on that emotional level. You can see yourself there. You can imagine yourself being there. You can imagine there being tenants in there.
Yeah, I got a story like that too. Yeah.
Hey, and you know what? And I did well in terms of capital growth. That place did well. And I won't get into the guts of sort of the mechanics of that investment property, but emotionally, you're sort of drawn to that. As my journey has gone on, and I've bought various properties over the years, and many of them with yourself, you come to understand that it's not about yourself, it's about the economics of the investment property. And the ugly ducklings, often offer, for those that are looking to, for the tenants, they offer affordable accommodation with, as long as it's practical and it's of a decent standard and it's clean. They don't have to be the most aesthetically pleasing.
And they're a great stepping stone as well. And I'm the first to acknowledge that I think you should have a mixture of different property and price brackets within a portfolio because it gives you, great risk mitigation, so to speak. But for those that are just looking to start off and perhaps they're handy and they can invest a bit of sweat equity to make something a little better than it is. And by that, I mean, it could be something as simple as paint and carpet and doing some lawns and some landscaping. And it could increase the cash flow and the value of the property in a given amount of time. It's a good way to get in to the market. And especially in a fundamentally correct market.
So in a tough market right now, or at least not a tough market, but in a market where it isn't a clear-cut market. So you just recently spotted, a property. So what attracted you to this particular property? What was it that sort of drew you to this as being a potential?
The area and the fundamentals. So, and we've invested there last cycle, and so have you. I think it was 28% below its peak price. Now, I know that's just a pretty sort of attractive or sexy number to spruik, but the fact of the matter, it was, and it was cosmetically challenged, and it did need a haircut and a shave to accentuate its value and its cash flow. But it took a certain type of buyer with quite a large deposit to be able to do it. And so those that are prepared via liquidity, whether that be offsets, line of credits, or what have you, and have finance in place, usually are the people that get the better deals at this state of the market. And we're talking Sydney, of course.
So 28% below its peak, is that's representing potential some good capital growth, assuming that the rising tide brings it back to the level it used to be, which historically they always have done.
Yes, sometime it will.
So there's an opportunity for some capital growth over a period of time. What about a yield on that particular property? Do you think what was the scope for yield there at the moment?
5%.
Okay, so that's pretty good.
Once it's done.
So that's good in the marketplace right now.
It's great in the marketplace, especially like Sydney, who's probably around about 2.5% or 3%. And some areas do have an oversupply of accommodation for tenants, and that's a whole different story. That was always going to happen, but then so does every capital will go through that part of the cycle. And I think the ability to be able to perhaps model when that time of the cycle happens so that you're out well beforehand is very important. So if you take Sydney as an example, and it's not all about Sydney, but those that perhaps kept purchasing in 2017 on this wave of perpetual motion and FOMO are now probably in a negative equity position, or there's a good chance that they either are or they will be in a negative equity position, because as the market contracts and they maybe got a 90% loan back then, it's not a very good position to be in. You combine that with a lack of cash flow, so at a 2.5% or 3% yield, and you're going to be reliant upon the growth that comes next cycle, and nobody knows when that will happen.
Yeah, and that's a very good point. I mean, negative equity per se sort of doesn't really matter, because unless you're forced to sell, you're not in hot water. But the problem with negative equity is if you want to capitalize on an investment to get ahead, you've got to wait. It doesn't really impact, as long as your rent stays the same, as long as, the bank isn't breathing down your neck, you're okay. But it just constricts your ability to recycle capital and to move ahead.
Yeah, and that's the whole, because capital is a finite resource. It can only take you so far. So you need to recycle it, as we call it, so that you can dip in and take out and then move to the next property or area or whatever it may be, and rinse and repeat, as simple as that sounds. But if you've got a market or a handful of investors or owner-occupiers with negative equity, then there's a good chance that there's a greater community with negative equity. And then what that does is it starts to affect consumer confidence and the flow on down the economy, such as Sydney. And then if you overlay that with the Royal Commission and the potential of negative gearing being scrapped, the flow on from that, in line with negative equity, if that happens, to the economy is huge.
Yeah.
And I think that's where we'd hope that perhaps people would think a little harder.
Oh, there's a, you know what? If you want to be frightened, there's a lot of things to be frightened about. The commentary around mortgage broking. If commissions do get scrapped for mortgage brokers, the potential impact of competition is catastrophic. Politicians, the media, and most borrowers just don't understand, what the real debate is around brokers.
100%.
And the thing is, I use a broker. I've used a broker. You know what? The reason why I'm stood here today, and the reason why we're having this conversation, is in 1998 when I bought my first place. I got turned down by all the banks. I had a regular income. I got a good job. Got paid half decent money. I couldn't get a loan. And I was not like a credit impaired borrower. There was nothing really unusual. It's just the fact the banks were absolutely useless.
Yeah.
And it came really close to settlement, and I was starting to get in a bit of a fix. And the developer actually said, look, I don't know if you're aware of a mortgage broker, I'll get a broker over. I actually didn't care. I didn't care who they brought over. I needed to settle on my property. I needed to make sure that I was good for the settlement. I didn't want to get any more, sort of
penalties,
yeah. or worse still, not be able to, not be able to settle at all. Yeah. So a broker came along, sat down with me and said, don't worry, we'll get you a loan. You're okay. And I said, but I've been turned down. They went, oh, look, we'll get you a loan with ANZ. I said, they've already turned me down. I went, don't worry, we'll be okay. Because I'd applied to ANZ in Hong Kong, where I lived. So, look, the point being is that brokers are a valuable force in the marketplace. They can help most borrowers find a loan that matters. The problem is that if you get rid of brokers, it's going to be it's mainly challenging to investors, I think, but to everybody, because first of all, you lose that variety of products that are out there. You also lose the competitiveness of pricing. So you're going to see mortgage rates, potentially
it will have an
up.
effect on the market, and I don't think people are really grasping that, or the general the consumer. And furthermore, to the broker, generally speaking, if it was purely up to the banks, and I'm being very general here, so don't come after me, banks, that the credit department is there to find a reason to decline the loan. A broker's scope is to find a way where the loan passes, and there in itself is the issue. If the banks need to lend money to make money, and they're the sole provider for mortgages, then the rates will increase and they'll take on the less riskier, in their eyes, the less riskier clients. And it's as simple as that.
I think, looking at it today, so there's some uncertainty about mortgage broking, which is not good for the marketplace. You've got, a changing market, property market, in all its little sort of patchwork kind of nature across the nation. So that's a challenge. You've got political change coming along. So there's lots of reasons to be pessimistic. However, you know what? Having gone through, same as yourself, through many market cycles, you realise it's just normal. It's just change, And I think for investors looking to get in the market, understanding how to pick through opportunities. And I want to come back to something you mentioned a little bit earlier, just to help, I think, give a bit of visibility. I think understanding how to invest, where to invest, and why to invest in a changing market is real gold. Now, you mentioned earlier on looking at properties that are cosmetically challenged. So I'd really like to get some insight from you. How do you understand what is a cosmetically challenged property and what is a poor build? So something that's maybe, because over the years we know that people, I'm watching it happening now. I live in Turramurra, just up in the North Shore, and I'm watching people who've knocked down perfectly decent old houses and building cheap houses on top which I know are going to fall apart in another 15, 20 years. So cosmetically challenged and a poor build. How do you actually work out what's what?
Look, it comes down to the pest and building report. So surrounding yourself with the subject matter experts, and in that case, it's a building inspector. But sometimes you'll get hints as to perhaps the build quality. So if it's, let's talk units as an example. When you walk into a unit, if you've got water stains all over the ceiling and it's coming from above, it's a waterproofing issue, that will cost you, and it'll cost strata. So your cost will continue to keep rising. Or when you look up the side of a unit block, and I've seen this hundreds of times, and instead of being a perfectly vertical wall, it's bent like a banana. I mean, there's going to be structural issues there. Or if you're just walking around a house, have a look at the external wall surfaces and look for cracked brickworks that go from the windows all the way down. Now, once again, consult the pest and building inspectors.
Yep. But you get an eye for it.
Yeah, you can get an eye for it. And the more properties you visit and the more that you do it, the better chance you have.
That's a really, really good point, Steve, because I think that you now have, because, through the various, sort of sites where you can go and look at listings, you sort of feel like you look at a property. You feel like you look at a lot of properties, but all you do is look at pictures that real estate agents have taken of the best angles, and putting boots on the ground, going along and visiting properties, even properties that you don't intend to buy, and in different price brackets as well.
Yeah, bit of ground truth, as we call it. And I think you've got to be really careful that searching is not researching. There's a big difference between the two, as it said. But coming back to the photos on realestate.com, as we know, they Photoshop the photos, but sometimes they're not that good. So when you actually zoom in on the photos, you'll see if there's any step cracking on the external walls and bits and pieces. But nothing will beat that subject matter expert, and make sure that you always employ a pest and building inspector. It's a cost of business.
So if you go to see a property and they go, we've got the pest and building inspections here, do you still go and get your own?
Always. I never rely upon anybody else's, because that's the vendor that has employed the inspector. Not that they can lie or anything like that, but I always want independent reports. That way I can have a chat with the inspector, because often what they put on paper versus what they tell you over the phone could be a little different.
Yep.
Obviously the ones on paper is full of disclaimers and worst case. But I think as build quality goes, and this is really important, because as the future goes on, the cost to hold that property or the cost to operate that property will go up, because there's a difference between cosmetic and structural. And that's the big point.
As far as I can see, there are twofold impacts from a poor build. So one of them is capital growth, because then if it's a poor build and you haven't spotted it, the potential for that to go up in value, unless you're looking at land value alone, is compromised. But you've also got an impact potentially on your yield, because if you are doing structural changes and having to patch up bits that are falling apart,
continually,
it's going to have a real impact on your overall investment.
Yeah, and it is, and it depends on what the purpose for the property is. So, if I'm buying a 3-bedroom fibro house from the 60s or 70s on a corner and I plan to knock it down, well, I'm going to do what's necessary to keep it habitable and safe, knowing that I'm not going to spend too much because I want to tear it down in 10 years' time or whatever it may be. But if I'm buying a property that I have no intentions to doing that, my cash flow will be impeded if I'm continually doing repairs and maintenance. But as a side, all property needs repairs and maintenance. It's just how much is it because of foundation issues that I'm continually patching walls or getting engineers reports or whatever it may be. So that diligence beforehand will make a huge effect, or have a huge effect on the outcome in the years to play.
So you said a little bit earlier, you'd said, and a point that I thought was quite interesting. So even though it's a buyer's market in many of the sort of the micro markets we have across Australia, you said something which I thought was quite interesting. You said that a lot of sellers are still holding off. So even though it favours the buyer, you still feel there's a lot of stock that's being held back. Yeah,
and this is where the data once again is perhaps not truthful, because there's a market in flux. You have some of the sellers that are waiting to see the result of the Royal Commission and how that will play out, even though that might be 6-12 months down the track. And you also have the election. And historically, people always start to slow down around an election, buyers and sellers. But because we have no pressure on a lot of vendors to sell, so by that I mean interest rates are still very low.
Yeah.
The last time we saw this type of contraction in the Sydney and Melbourne market was when rates were 17% as a cash rate. We're at 1.5.
Yeah.
So there's no real pressure for sellers to sell if they don't have to, as opposed to perhaps the GFC.
Yeah, that's a very, very good point.
And so if they can hang on, they will. If they don't get their price, they'll hang on, because there's no need for them to sell. There's no pressure.
You feel that, I'm not an economist, but just looking at cycles that have happened over the years, we've had low interest rates now for a long time. I just sense that there is going to be some sort of upward movement in, probably 12 months, maybe 18 months. Just history says that they don't stay low forever.
And I think that's where the gold is, because if people are just hanging on now to their properties because not so much because of the expenses, but because of the income, so rents are contracted because of oversupply, and they're paying, let's just call it 4.5% or 4.7%. What happens when they get to 5.5%? Now, this also comes back to asset selection. So if you're buying something with a 2.5% yield worth $750,000 and you're thinking it's okay now, have you modelled it out when it's 5 or 6%? And there's going to be hurt there one day. But and I'm not an economist either, but and I think rates will go up eventually, they have to, but there's nothing within the economy now for the Reserve Bank to put them up. We have low jobs growth. Unemployment just went up again. Inflation went down again. There's no wage growth, as I said. So people are holding on to their money because the wealth effect, because of the contraction in price, people are hanging on to their money.
There's no trigger.
There's no spending. There's no trigger for rates to go up from the Reserve Bank. I think banks will, though, because of cost of funding.
Yeah.
And I think, it won't go up 1 or 2%, but every blip has a direct...
It's interesting though, with banks as well, because you've got sort of a double-edged sword there, because as lending slows, then you want to continue lending, so sort of pushing rates up. So it's kind of hard to pick how it's going to go. So I just want to have a look at drawing on your experience and maybe looking at investors in different sort of groups. So for people who are new to market, people who are they've built up a deposit, they're looking to get in the market. What kind of assets do you think represent the best in today's market, the best opportunity for new investors? What kind of assets should they be looking at?
In terms of property?
In terms of property, yeah.
I think they should always look for the long term. Don't look for quick wins, because that's pure speculation, and you may as well go to the casino. So I think you need something fundamentally crap that's going to give you ample cash flow, because whilst we talk about cash flow being king, it's more about cash flow management is king.
Yeah.
Because you can have all the cash flow coming in, but if your expenses aren't in check, well, then sustain negative effect. So I would subscribe to the fact that, look, something that's affordable for yourself, for your own household income, in line with the future and your plans. And that's going as far as, well, do you plan to start a family? Do you plan to upgrade the home? So it's quite a science behind it, I think, if you take it real, or if you be real about it, I should say. And I would be, in terms of area, depending on the goals, depending on the budget, depending on the capital, I think some areas of Brisbane still represent good value.
What are the fundamentals that are driving the attractive nature of certain suburbs of Brisbane? What are the infrastructure things that are happening there?
Oh, well, infrastructure, and the fundamentals, jobs growth, universities, but also looking what's in the pipeline. And I think this is where investors get it wrong as well. So they look about the now, but they haven't been to, say, council and talk to the town planners to see what's in the pipeline in terms of DA approvals and construction, because that'll have a direct effect on their rentability in 2 or 3 years' time. So that's a really important factor. So yes, the infrastructure, the universities, train lines, freeways, so on and so forth. Larger blocks anywhere are always a favourite of mine, because they just don't make, let's call it 1,000 square metres. They just don't make 1,000 square metres anymore. And I think some areas of Brisbane's 1,000 square metre blocks are undervalued. Now, I don't mean under market value, I think undervalued.
Yeah.
In fact, some areas there, if they're in the right areas, you can pick up 1,000 square metres for the cheapest anywhere in Australia, and that includes Tasmania. It doesn't make sense for me. So we try to control them as quickly as we can. I think certain parts of Sydney, as I said, in the Central Coast and Wollongong, might take a little longer to contract, but depending on the budget, there's some opportunity there. South Australia.
Okay.
We've been in South Australia for probably 2 years now. We've done very well out of it.
So when you say South Australia, I get to sort of move away a little bit. You're looking at sort of city-based, suburban, or how about some of the regional towns? No,
I think so. We're in Adelaide CBD, well, not CBD, but no more than 20, 25 minutes from the CBD is our cut-off point, which is quite different from other states. How we invest. But Adelaide has done very well for us. Although my advice would be there will be an oversupply of units because there's a lot of construction going on there. So stick to the larger blocks. Okay. Once again, but it's not about cash flow.
So you talked about sort of 1,000 square metre blocks do crop up in the Brizzy area. What about in Adelaide? What sort of size sort of blocks of land can you hope for there?
Look, for me, it's about what I can do with them. So I don't want a 900 square metre block as an example if I can't do anything with it. If it's a wedge-shaped block, it means, unless it's about pure value.
Just waste of space.
Yeah, so I want something that I can split in half. That's what we're looking for.
Yeah.
But it's important to know that the yields are contracting in Adelaide as well. So whilst it used to be about nice, steady, reliable growth perhaps, and cash flow, now it's not. So you just got to be careful there. But to the regional statement, we've invested in regional areas before and it's done very well for us, but there's a time and a place for regional.
How are yields in the regional areas at the moment? Because they have been historically sort of higher than some of the metro areas.
Yeah, they are, but there's always a reason for it. And although having said that, some regional areas you're still only getting 4% yield.
Okay.
But there's a time and place for regional, and there's got to be a direct purpose for it in your portfolio. Don't be sort of dragged into the debate about people are moving out there because of affordability. There's always a certain amount of jobs out there. There's always a certain amount of population growth. But we can never forget that Sydney, Melbourne and Brisbane, in that order, are the magnets for immigration and population growth, and it always will be.
Yeah. So what about for investors then that may be sitting on a portfolio they've built over, let's say, the last 5-6 years, let's say the sort of the 4 to 6 properties in that portfolio, sort of maybe sort of a portfolio, I don't know, getting up to sort of maybe 3 million sort of size. And let's assume you've got a little bit of capital in there you could potentially release. What kind of assets, what kind of price bracket and assets would they be looking at? Would you be sort of suggesting? And let's say, this is people who've bought in the last rise of the market through Western Sydney, maybe some of the early sort of gains that came out through Brizzy. So how would you look to leverage on those investments moving forward in this current marketplace?
The very first thing I do is be liquid. And we always talk about be liquid all the time.
Yeah.
It's not as it just mitigation for you, but it's your opportunity to execute opportunities, so to speak. He with the most cash will always do well. And I'm going to be very general here because everyone's got a different, unique footprint in terms of their finances, but I'd be looking for diversification. So if I've invested in Sydney the last cycle and then I perhaps moved to Brisbane and I've got my share there in terms of exposure, and now I'll call myself a sophisticated investor because they've got 6 properties and they're doing very well. Once again, I'd look for some diversification, potentially entertain the idea of some areas of Perth.
Okay.
Don't buy into the green shoots sort of scenario because that's a lot of vested interest trying to perpetuate that or push that along. But there is some opportunity there. Once again, I'd be concentrating on the larger blocks that I can split, keep away from units, and keep close to the CBDs. Don't go regional. I think Canberra has had its time. It's been and gone. So you're buying somewhere near the clock. Tasmania very much the same. South Australia, I think there's some opportunities. Sydney, some opportunities. If
you're mindful in Sydney, there's those gems that you come across every now and again.
And that's it. And if you've got 6 properties, because there's never a number that you should, don't get caught up in this person's got 100 properties or 30 or 6 or 2. It's not about that. It's about what it represents to you in net equity and net cash flow at the end of the day and what your goal is. So I think depending on what the goal is, and how big your portfolio is will also dictate where you should go.
And I'd just like one final gem from you. Having dealt with real estate agents for many, many, many years, on your personal journey in terms of property and for many of your clients, right now, if you can give us a bit of a snapshot, a bit of an insight into the psychology of real estate agents. They're doing a bit tough. As you say, they're struggling to get the listings. How can investors capitalize on real estate agents who may be feeling a little bit nervous at the moment?
Create the relationship.
Yeah.
Everything is about the relationship with the agent. At the end of the day, they make their money by selling a property, and so you need to be front of mind. Keep in constant communication with them. Let them be truthful with them at the end of the day. So if you're going to throw plenty of offers that might not be attractive, let them know that, but make sure you complete. And spend the time to research the market where you're going to go. And that's not just from a data point of view, but also spend some time on the ground because often the two will be quite different and there'll be small areas of overlays. So I would suggest speak to the agent a lot. And do not rely upon the internet alone.
So I think very valuable stuff. And having gone through the process of selling a property, very, very interesting. I sold my place in Pymble. I moved midway through last year, and the agent did a fantastic job. But I knew there were only 2. There was only one really serious buyer. There was maybe somebody else sitting on the sidelines. But the impression was, and the buyer who eventually bought was absolutely, they were in anguish to get the place because the agent had created a very good illusion that there was a lot of demand. So I think in terms of understanding the reality of even in a fairly decent market, there are a lot fewer buyers actually looking at a property than the agent may let you believe.
Yep.
So having that confidence to know that. And I think to your point as well, I think treating agents with respect. I think some buyers think that they can kind of show them who's boss, and and if you get an agent offside, even as a buyer, they'll dismiss you as somebody who is a tire kicker. So having your pre-approvals ready, showing that you understand the market, showing you've got respect for them, and showing them there's a deal to be done, but being firm in terms of the price you're prepared to go to.
And keep your ego in check. Like, don't ever let ego sort of get in the way of a good relationship. And often, as you said, to your point, that some buyers just want to play this hardball game during negotiation, and it just doesn't work like that. Good agents spend tens of thousands of dollars a year on personal training and sales skills and what have you. They're very good at what they do, so treat them with the respect they deserve.
Steve, thank you so much for your time. Look, thanks for tuning in. There are always market opportunities out there. Look, take heed of Steve's advice. Be a good buyer. Have a look at your portfolio. If you have a portfolio, make sure that you've got liquidity on hand. Talk to your broker or your bank to make sure that there's funding available, and just think about opportunities as they arise. Because things do crop up. You can be opportunistic, and in many ways, in a tough market or in a flat market, sometimes those gems do arise. So keep looking, keep investing, keep researching. Thanks for tuning in. Don't forget to check out all our other podcasts. If you like the podcast, please make sure you share, rate, and give us feedback. I'm your host, Alex Whitlock. Thanks for tuning in.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.